Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, November 10th, and I'm recording this en route to JFK Airport. Since the S&P 500 hit an all-time closing high on October 28th, the market has stalled as it enters what is usually the strongest stretch of the year. With forward price-to-earnings ratios now above 22 times, investors appear to be questioning where the bull market is heading. Specifically, we see an intensifying tug-of-war over where we are in the business cycle. On the one side are those who believe we're early in the economic cycle, and they expect growth acceleration in 2026 with a pro-cyclical broadening in the market, led by small caps, cyclicals, and high beta stocks. On the other side are those, including us, who believe we're in the late cycle, with 2026 likely to bring a grinding, narrow bull market where the sustenance of generative AI CapEx is the only story that really matters. Lately, a number of developments have weighed on the early cycle narrative. First, let's consider market spread, which was extremely healthy from April through September, but has since deteriorated. Over the summer, in fact, nearly 80% of stocks were above their 50-day moving average, but that number has since dropped by half. Second, despite excellent earnings in the third quarter, earnings revision spread has rolled over, and earnings estimates for 2026 have been increasing at a glacial pace. This suggests to us that some caution is now creeping into investor positioning. Another factor is the growing debate over whether the Fed will cut rates in December. Fed officials have now declared that their next meeting is in fact live, and market expectations for a rate cut have fallen from nearly 90% back in September to around 60% now. Bond yields have thus risen 15 basis points, and rate-sensitive high beta stocks have begun to pull back. Recent data on capital spending intentions is also not consistent with the early cycle view. Regional Fed manufacturing surveys, which tend to lead actual fixed investment growth by 6 to 12 months, have shown limited improvement since their lows earlier this year. Similar tentativeness was also seen in the recent New York Fed survey, with CEO readings at their lowest since 2020. Finally, dynamics in the labor market suggest we're closer to economic slowing than to reacceleration. Consider that the October gain of 42,000 private sector jobs reported by ADP was likely neutralized by government furloughs and employee reductions. In fact, in the Challenger's October U.S. employment report, job cut announcements surged to an extraordinary 153,000. All that said, it is possible that a policy catalyst could recharge the early cycle thesis, especially given that the drag from government shutdown may be approaching an end and that the Supreme Court tariff rulings could partially relieve pressure on corporate margins. Nevertheless, we think investors are right to be refocusing portfolios towards mega-cap tech leaders and large quality companies. This late cycle perspective motivated our latest tactical change in mid-October. For now, we're sitting tight, anticipating a bull market that lumbers rather than gallops into 2026. Consider, therefore, rebalancing for maximum strategic asset allocation diversification. Avoid single stock concentration and take profits in high beta, unprofitable, small, microcap, and speculative names where gains could be vulnerable in 2026. Now is the time to redeploy to large cap core and quality stocks, including the Mag 7 and generative AI productivity beneficiaries in financials, healthcare, and in energy. In fixed income, focus on quality and benchmark duration between 5 and 10 years. International equities and real assets, including gold, real estate, and select private infrastructure, are opportunities to add. As always, thank you for listening, and for more information on portfolio strategies and financial planning insights, please reach out to your Morgan Stanley financial advisor.